investing in 2021, the world upside down. Now, just to make sure that we all talking the same language here, no financial advice from me, because I have no idea who you are and what your goals are in life or in the share market. But I will present to you today as the editor of FNArena and as a keen market observer and analyst. I think the best way to start this year's presentation is actually to go back to the grand debate that was taking place in and around financial markets over the past 5 years. And that grand debate is very simple. In a very simplistic manner, it can be brought back to two listed fund managers in Australia. One is Magellan Financial. I'm sure that most of you would be aware with or would be familiar with Magellan. Hamish Douglas has been at times treated as a demigod in Australia because he was doing really, really well with his strategy. And that has come a little bit unstuck in the past 5 months. And then we have Platinum on the other end, which once upon a time was considered to be the local equivalent of Warren Buffett. And over the past 10 years or so, on my observation, very few people were still interested in what was happening at Platinum. And there's a very specific reason for that. Whatever Magellan was doing was working, and whatever Platinum was doing wasn't working at all. And I've summed up at the bottom of these slides. I'm not going to go through it, but I'm sure if you read quickly through it, you'll get an idea what the different dynamics were and why Magellan was performing so well and why Platinum wasn't. And we can all judge by the share price performances of both fund managers how market dynamics were evolving. And over the past 5 months, it has completely reversed. Platinum is now the hot stock in town, sort of, and Magellan now comes with a lot of question marks. And that's the debate that, for the time being, now is skewed towards the Platinum view. Value investing is back in fashion, but it doesn't mean that the likes of Magellan will be proven wrong over the longer term. And I'm sitting somewhere in the middle on this one. Not always, but in this case, I still lean towards the Magellan view over a longer period of time. But in the short term, it's probably clear that the Platinum view is back in fashion, and for very good reasons. Before we go to those reasons, still before the pandemic hit, we had lots of discussions, which we always have, about what shape the economic trajectory takes. I think it was increasingly becoming clear that instead of a U or V or W or an L or a Nike swoosh, we were having a K type of economic development. And the K, as you can see on this chart, basically was increasingly picking winners and losers, and the gap between those two segments of the share market was increasingly getting larger. And the reason for this is that we were gradually getting boxed in an environment when there's no inflation. Bond yields were going ever lower. Economic growth was continuously challenged. We had very low economic growth numbers, and we ultimately then were hit with a technological disruption, which disrupted a lot of traditional business models. And on top of that, ultimately we got a global pandemic. Now, picking winners from losers was the game in town. It was for between 7 and 5 years prior to 2020, and it definitely became the game in town in 2020. And that all of a sudden changed in late 2020 when we had got news that we would have vaccines, and so economies had a trajectory to back reopening, and that changed dynamics in the market. Now, to understand why that switch was so violent and why it had such a great impact on fund managers and on the share market, etc., is here you see on this chart, we see that gap I was talking about between winners and losers, and this chart is sort of trying to depict that the difference between, in very simplistic terms, between a CSL, a ResMed, and an Aristocrat Leisure and a Macquarie on one end, and on the other end we had the facility centers, the banks, the insurance companies, and some retailers. And so we get the growth versus the value part of the market. That's how fund managers see it. And this particular chart goes back 30 years until 1990. And you can see that while the dynamic between those two segments of the market has always been there, in particular around recessions, it was never very seldom as violent, as pronounced as it was in 2020, when it just kept on going, and the pandemic just brought on another chapter in that. So in 30 years, the gap, the relative valuation gap between the winners and the losers in the share market had never been as large as at the depth of mid-2020. So it goes without saying, once that dynamic changes, it was always going to be violent and big. As you also can see from this chart, what we've seen so far, even though it looks very, very pronounced, in the bigger scheme of things, if this would ever go to parity again, or to more what was usually regarded as a more normal relationship between the two, there is still a long way to go, and that's what you get when you move into extremes, which essentially is what this market likes to do. Now, the reason in the background, everyone will talk about the reopening of the economy, but the big driver of assets is usually the bond market. And the reason why you haven't really heard a lot about the bond market until quite recently, and this chart shows that perfectly, is because at the end of the day, the bond yields have been in a long-term decline, which basically means that bonds itself have been in a 30, 40-year bull market, because when bonds move up, the yields goes down. And that has been supportive of equities in general terms, and with exception of occasionally in 1994 or maybe in 2012, 2013. Usually equity investors are not used in talking too much and paying too much attention to the bond market, but now they are, and now they will have to. And in my writings this year to FNArena subscribers, I made two predictions at the start of the year. One is volatility will be back and will be with us for quite a while. And the other thing was, we are going to be talking about the bond market a lot this year. And I think we're now 3 months into the year, and I think those were predictions that already have proven their validity. To put things in perspective a little bit here, I mean, yes, we are in a long-term decline, and it's not necessarily that decline has ended here, although the narrative is changing around the bottom. But if you see what has happened before, what has happened effectively since mid last year, at the very right end of the chart here, I mean, it hardly registers on an historic view, considering we're coming from 16% and we're now dabbling still below 2%. But the narrative is changing, and that's why it's so important. There's two reasons why this is so important. One is that we have priced assets on ever lower bond yields, and that is now correcting. And that's why we have a big impact on amongst other things on equities. But also the narrative is changing, and the market is now taking a view that we might actually see a return of inflation. And that is important for many reasons. One reason which equity investors usually don't take into account is that when you have a period of low bond yields and low inflation, they both translate into higher valuations for equities. So if we now get a period of higher bond yields and potentially higher inflation, then that should weigh upon equities valuations. And that's why everyone is getting nervous in the share market, because what looks like a small adjustment in the bigger scheme of things can easily translate into 15, 20, 25% correction in the share market, which would, in a long run perspective, would also be a blip in the bigger scheme of things. But when you are going through it at the moment, or in the moment, I should say, it can look quite violent and quite sharp. And that's the reason why we're all getting nervous, and we will be keeping a close eye on the bond market this year and potentially the year after. Just before we move away from this chart, if you look at what was happening before we had last year's pandemic here, and the average bond yields on 10-year government bonds would be around 2.5%, I would say. And it was moving between grossly taken 2% and a little bit less than 3%, which means, all else being equal, if we were to move back to that range, which was prevalent before we moved into the pandemic, then we might still have a while to go. And in particular, central bankers would be getting a little bit uncomfortable if we were getting there. And they probably are uncomfortable right now, I would say. The market is not on one line with central bankers here, and it is not yet clear who's going to win this war. I've made it very simple here. We have rising bond yields. In a very simplistic format, government bond yields in the US last year were pretty close to 0.5%. They are now more than 1.5%. Everyone can do the maths. That means they tripled, and that's what you get when you are playing with low numbers. In the share market, people love to invest in 1 cent or 2 cent stocks because it only takes a cent and you percentage-wise have a lot of profits. In the bond market, the same principle accounts. I mean, if you have low yields and it moves to a little bit less lower yield, before you know it, you're talking doubling, tripling, quadrupling of yields. And it does have an impact because the pricing of assets is being affected. I wouldn't concentrate too much on the winners and losers of rising bond yields. This is research done by others over many years. The most important things to look at here is that when you go to the winners, the top sectors listed here are all financials, starting with the banks, and that's probably lesson number one to draw. It's financials and energy, and those are very unsurprisingly the top-rated sectors regarded as most attractive by professional investors, both offshore and locally, if we get this continued environment of rising bond yields. On the loser side, without getting stuck into too much detail, but you can see from the top sectors that are being mentioned here, they're all technology. And those are basically the two camps you now have in the market. You basically have banks versus technology. And that's definitely how investors will see it. And this is the reason why some of the stocks that were market darlings until weeks ago, all of a sudden are no longer a darling, because they're basically in the loser camp when bond yields go up. A special mentioning I've put here on the bottom. A lot of people don't understand properly that gold is also amongst the losers when bond yields move up higher. So if anyone of you had gold or gold exposure this year, you would have noticed that has not been very profitable. And the answer that you're looking for is not central bank, it's not manipulation of markets, it's not Bitcoin, it's simply rising bond yields. Now, I already pointed out in the previous slide that it's what bond yields do essentially, it divides the market between financials and technology and pits them against each other. Now, here we have a chart that from someone else who's obviously very smart as well, and has placed that on a price chart so we can see how the market has actually developed between those two extremes in the share market. And you can see that prior to the change we had, we're going back to 2020 at the very end, mid last year, the gap between those two in favor of technology had actually exceeded the gap we had experienced at the late 1990s, early 2000s. So it was rather extreme at that time. The gap, as you can see at the very end, has very quickly corrected now in favor of the banks. And we've seen in Australia, for example, that the banks that were more than 5.5 years underperforming the broader market and were completely out of favor in Australia have made a very sharp and quite strong comeback on the back of that international correction. And it probably also means that in the short term, this violent correction probably has done its run now. And in recent days, we've seen a little bit of a normalization that some of those technology stocks in the local market, for example, have recouped a little bit of those losses they've made, and that's a natural process in this correction between those two camps. Having said so, I don't think that anyone who's an avid investor in technology now should have too high expectations for the short term. I emphasize for the short term, because I do believe that this process on the back of the bond market shenanigans and the bond market basically putting to test the resolve of central bankers, it probably has more to run than it has done so far. Now, a particular characteristic of the Australian share market is that while in the US we see these public debates between long-term and shorter term, which basically means that everyone who's been in technology stocks over there and still owns a lot of technology stocks is often refusing to accept that the short term will be a better choice to follow than the longer term. And there was something to be said, a lot to be said, that some of those tectonic changes we've seen over the past years, and they are technology driven in most cases, they're not going to end this year or next year. So there's definitely still a longer runway to go. But in the context of the Australian share market, the change in dynamics has been quite violent and has been much sharper than at any time overseas. And in particular, Australian banks, of course, are a very major component of the local index. And obviously, after 5.5 years, they made a comeback, and now a lot of investors are back again, jumping on board, buying banks, and etc. Morgan Stanley recently put this chart together, and it sort of compares periods in the past when the banks were having a cycle of outperformance in comparison to the broader share market in Australia. The current one is that little uninterrupted black line, which, as you can see, has hardly had any time. It's only five months old. Such a cycle can last quite a few years. As you can see from this chart, with the exception of one of those cycles, usually the outperformance takes it to 40%, if not higher, 50. At the moment, we've done 20. So if you believe, and I think there is probably some justification for that belief, if you believe that the outperformance of the banks, the relative outperformance of the banks has further to run, then there is probably an expectation that there's a 20% more to be had, and a longer time span as well, because although I must say, and things move a lot quicker these days than they used to in the past. So it may well be that we shouldn't focus so much on the timeline here, but maybe on the outperformance in general. One thing that the banks have going for themselves is that they will be reinstating their dividends, and they have amassed a lot of excess cash because they were restricted last year in paying out dividends. So there's a general expectation rising in the market that they will be paying out, if not extra dividends, they will be buying in the extra shares or do something similar. So there will be returns to be had from the banks on top of the share price performance. This is the chart I referred to earlier. The outperformance of the value part of the market in the Australian share market has been incredibly strong and much stronger than what we have seen in emerging markets, in Europe, and in the United States. And I believe that one of the reasons for this is the index composition in Australia. If you're a fund manager, you would be always keeping your eyes out on the likes of BHP, Rio, and Fortescue, and the four banks, because they will decide whether you will be outperforming the market or not. And because that's of much bigger importance in Australia, I believe that the adjustment has also been a much stronger in Australia. But I mean, if anyone has a different idea, I'm all ears. But I do believe that the composition of the index locally is a major influence in this, and we've seen that. I mean, some of the technology stocks locally are down by 40% over that period, while the likes of Apple and Microsoft in the US have hardly moved in a relative perspective. Further adding to the bond yield story, to keep things into context here, bond yields may have been moving higher, and they are still on an uptrend. When you correct them for inflation, they are still negative. And you see this chart has been taken from last year before we had moving bond yields. So they were a lot more negative than they are this year, but they are still negative. And in particular, in the most important countries in the world, which are Japan, China, the European countries, the US, and locally Australia. And the general expectation is that central bankers will not allow bond yields to move into positive territory when adjusted for inflation, because they will want to further support economies, and that's generally seen as a form of tightening and would therefore weigh upon economic growth going forward. So the big battle that at some stage will ensue, and central bankers are probably preparing for this, is that if bond markets keep on going up and inflation is not coming, then they will have to be somehow kept in check. If inflation is coming, that means bond yields will move higher, and we should expect the same battle though, because it will be difficult at some point, probably, to tame the beast, and we'll have to see how that goes. Now, another consequence of changing the dynamics in the bond market is that all of a sudden, of course, see, if you follow financial markets like I do, then on occasion you see that the market gets really carried away. It could be with cryptocurrencies. It can happen with micro stocks. It can happen with some of those story stocks. If this happens equally with an asset like oil or a currency or a bond market, then that has consequences that go much further than simply buying up a microcap stock into infinity. And so at some point you will see a response from authorities, because it has consequences. And in this case, the general expectation is that people who are in the bond market, they look at what's happening and they see the implications of this. And the implications are that the RBA is going to raise interest rates much quicker than they are communicating with the market. And that obviously can mean two things. Either the bond market is running well ahead of fundamentals, or either the RBA will have to change its stance. I think in general terms, the RBA is making very clear to the market they are not going to change their stance, which means they're going to keep things accommodative until 2024 at the least, which again brings this battle to the core. And I think at some point the bond market will have to settle, and if they will not do it at their own volition, then central bankers will force them to settle. But before that happens, we can have a lot of movement and a lot of shenanigans and etc. And in particular in the United States, the land of freedom and of free speech, the central bank will not easily go to interventions like we see in Japan and locally. in terms of yield curve control and etc. Enough about the bonds now. In the background of the bonds, we also have currencies, and they are often driven by what happens in the bond market as well. Locally, of course, we've seen that the strong move up in bonds, and the bond yields now in Australia are higher than in the United States and have been now for quite a while. That has translated into a stronger currency locally. Now, central bankers do not necessarily see that as a bad thing until, again, it becomes too powerful a negative. In the Australian share market, it's the currency. It doesn't affect many companies, but it does affect a lot of the important companies. And I mean, a lot of the successful companies locally have been very successful in rolling out an international expansion. And we have some very, very highly qualitative and successful companies in the Australian share market, starting with the likes of CSL, ResMed, Computershare, Cochlear, Amcor, Aristocrat Leisure, James Hardie, and etc. And they are all, of course, affected by the fact that the local currency, the Australian dollar, has been incredibly strong. Just to put things in perspective, it wasn't that long ago we were talking a Australian dollar versus the US dollar in the 60 cents. It wasn't that long ago it was targeting the 80 cents. It has come back a little bit. What that means, if you are a locally listed company but you make most of your profits overseas, and let's just for the sake of argument say that you make between 10 and 20% profit growth this year. If the currency appreciates by 20%, that means you are not going to make any profit growth, and for the time being. And that's basically what the market then all of a sudden starts worrying about, and your share price will go down. Now, those things will not stay a given, of course, but for the time being, it is an extra barrier, an extra headwind for those successful offshore earners we have, and it has depressed the share prices. On the other end, the winners are not that. I mean, the most logical winners in the Australian share market are the retailers, and there's always a large delay in that they can source their produce cheaper, but they're often hedged, and it often takes a long while. So there's often a delay of 9 months, if not longer. And I've put energy and mining in there as well. It's because the reasons behind the strong currency is feeding into stronger commodity prices. So they don't really gain from a stronger currency, but they gain from the reasons behind the rising currency. It's just one of the extra complications that all of a sudden this year has popped up in the share market. The other way of dividing the share market, and in particular in modern times, the share market has been very good in picking winners from losers. Last year, it was very eager to pick the winners from the pandemic, from the lockdowns. This year, all the attention is on who's going to win if we are going to reopen economies and if we get a successful rollout of vaccines. Again, and in line with the title I chose for the presentation, whatever worked last year is now no longer working, and those last year who got really harshly punished and nobody was interested in buying them, all of a sudden they're back in favor this year. And I've lined up in a few names here, but like for example, there's nothing wrong as such with a Fisher & Paykel Healthcare or NextDC or a Goodman Group. It's just that for the time being, they are in the wrong camp, so to speak. And there's a lot less enthusiasm now to buy up their share prices, even apart from rising bond yields or any currency effects. And on the other end, we will remain interested in the likes of Sydney Airport, Qantas, corporate travel management, and the likes, because once economies reopen again and borders go reopen again, those companies should see a big boom period in that people haven't been able to travel and they would like to travel, and all of a sudden they come obviously from a very low base. That of course both impacts will fade away over time once that happened and once the other part happened. the dynamics are bound to change again. But in the meantime, this is a new divide that the share market has discovered, and for the time being, it is sticking with it. Most of you will know that I've been a very big advocate and a very loyal analyst of CSL over time. It's not so much that as some people accuse me of, I'm falling in love with the stock or anything, but I learned a lot from CSL in terms of how the share market works and how the pendulum swings and everything. I mean, it's basically a perfect storm that is hitting what was last year the largest stock on the share market, and without doubt is one of, if not the, it's one of the highest quality and most successful international expansion stories we have in Australia. Now, but what I wanted to point out here is because everyone will give you reasons why CSL is at the moment is not performing in the share market. And that will range from, I mean, there might be a currency effect, there might be a rising bond yields effect, there might be an effect that in some of the very specific sectors in which they operate, there is more competition happening. They are disrupted at the moment because the pandemic in the US is keeping people away from their plasma collection centers. But apart from all those reasons, I think there's another very valid reason here, is that prior to last year, everyone had become convinced that nothing could ever go wrong with CSL. And I think it was over-owned by everyone. And there comes a point when everyone just owns the share, and when people start selling, there's no natural buyer left. And I think that's been responsible for some of the share price fall. The other reason, of course, is that we are coming out of a recession. And last time we came out of a recession, which I've opened up here, it lasted 5 years, and the CSL share price didn't do anything over those 5 years. Of course, once those 5 years came to an end, the share price literally exploded to the upside. I'm not suggesting that at this point in time it's going to take 5 years for CSL to regain its former glory. But what I am suggesting is there's a very simple reason. When we come out of a recession, as a community, we're not interested in CSL. CSL offers us security, solidity, quality. But when we come out of a recession, we are interested in the likes of Sydney Airport and Qantas, because they are beaten down share prices. If there's any sign of recovery, we can double, triple, quadruple our investment gains. And that's why all of a sudden we are much more interested in elsewhere. The grass is greener with the neighbors now. And that effect, again, will run its course for an X amount of time. And when that effect has done its course, then all of a sudden we probably will start looking at CSL again. But not for the time being, no. And another element to point out here is one of those local technology. Well, it's supposed to be technology, but I think it's a financial. It's Afterpay. Very controversial, very misunderstood, I believe, and you should definitely not ask the typical value investor about his opinion of Afterpay. I don't own the stock, by the way, but I'm a very keen observer, because I learn a lot from Afterpay, just as I learned from Tesla in the US and other similar story stocks. But I thought this was quite remarkable, just to point out that when you're a technology stock and you're supposed to be an icon of the future, and you become very popular, then all of a sudden the dynamics of investing in those shares changes a lot. And you can see here that we've had, this is only a price chart over the past 2.5 years, and how many pullbacks we had of 19%, if not 38%, over that time. But ultimately the share price has ended up a lot higher. And I think there are some lessons, and there is some reflection that should take place here. In that, I mean, people have been calling this stock overvalued from 2 years ago, and it probably has quadrupled, if not more, 10 times over that time. Needless to say, it is a different type of investing in this type of stocks, and it doesn't mean that anyone is right or wrong. in not doing it or doing it. It's just a different type of sport, essentially. Now, coming back, because we are having this economic recovery. We're now having a revival of all the old economy stocks we had previously nobody liked, and they're all having a very bright future, at least for the short term, and that's why we're all buying them. Again, there is a context to that as well, and the context, I went back here at FNArena. We do cover reporting seasons quite intensely. I went back to August 2020 here. I should have maybe gone back to August 2019, because that was probably even better. It was similarly bad. We might have forgotten right now, but in late 2019, companies in Australia started cutting their dividends, including the banks. So economically, it wasn't going well, and they were not in great shape. And we were having, on our account, we were experiencing the worst reporting seasons in a decade in Australia. So that's what preceded the pandemic. Then of course we get the pandemic, and it gets a lot worse. And this is the reporting season that took place in August last year. And you can see just on the numbers there here, they just look bad. I mean, we have an average earnings per share of minus 20%. The dividends go down on average by 36%. It's almost double the decline in profits. We have 52%, more than half of the companies that reported no growth, they were going backwards, etc., etc., etc. And in the corner here, we have all the companies to whom this did not apply. They were doing just great. I mean, healthcare, non-discretionary retail, you have to think about Woolies and Coles, for example, Medcash also. The food and beverages companies, think about Domino's Pizza, for example, and obviously we had the local technology sector. They all performed really, really well. They had excellent results last year, and this year, nobody cares anymore. Because this year, 6 months later, we have probably the best reporting season in 2 decades. And obviously, again, there's a context for that, but the context, of course, is that we come from a very low base. The companies have slashed their costs. They have postponed capex investing, basically, and all of a sudden and the economic recovery is coming. And all of a sudden, you can tell here, this I took from a report by JP Morgan, but it sort of summarizes the whole thing. Dividends are making a very strong comeback. You can see here how the growth we are expecting is all of a sudden very, very high for the years ahead. Again, it comes from a low base, but that's not how the share market works. The share market doesn't care. Share market looks forward. So even if you come from a low base, we're still very happy with the growth that lays ahead. What will please a lot of investors in Australia is that dividends are making a very strong comeback, much stronger than expected. That is not necessarily good news for the economy as such, because you would rather see companies restructuring and readjusting to the new world that is opening up for the next few years, but they don't seem to be that interested in that. They're more interested in giving the shareholders an extra buck, which is good for the yield investors and for the income investors. You can see here the comeback of the banks and still high dividend payments from iron ore miners. The comeback for the ASX 50 has been stronger than for the ASX 200, and both, of course, are beating the small odds and the international indices. So dividends are very, very strong comeback. Time for me now to emphasize to everyone that same old rule, that if you have a stock that has a high yield, they probably have no growth, and that means they're very much more susceptible to risk and to bond yields. And so in an environment where bond yields are moving higher, your best investments, if you are interested in total return and not just in the payment of the dividends, and you don't care about what happens to the share price, but if you are interested in total return, then the best choices this year and next year may not be the high dividend paying stocks, like some of the REITs and some of the retailers. Well, the retailers could, if they have growth to match it up with. I've been making this point for many, many years. The superior investment strategy in the share market is to combine dividends with growth. It beats a strategy that only chooses one of them. So if you only go for dividends, that's the weakest strategy. And over time, probably, for example, last year, those high dividend payers, including the banks, were the first having to cut their dividends when times got tough. This is just a funny way of saying the same thing that I just told you. Coming back to income, this is a list I gave to investors last year in one of my presentations. I believe these are amongst the most solid and reliable dividend payers in the Australian share market. The difference this year is that the REITs in this overview, including APA Group, APN Convenience Retail, Charter Hall, Long WALE REIT, Centuria, and the Waypoint REIT, they will not have their best year this year, and the answer for that is bond yields, unfortunately. So this year, the superior way of investing in income stocks will be by picking industrials and financials that will first of all grow their profits and their cash, and then second of all increase their dividends for shareholders. This is just a very quick overview to see which sectors will be first in getting back to 2019 levels in terms of profits. I'm just giving this as a quick overview to see the damage and how long it will take for some of the sectors. It will not matter in terms of share price performance, because the share market doesn't work on these principles. It just works on very short-term outlook, what's going to happen with profits and with dividends, which is no relationship to the table you just saw. I'm obviously in an economy like Australia, I have to talk about resources. One of the terms that's increasingly making a comeback in Australian lingo is super cycle. One of the super cycles that has been predicted is one in dividends. Dividends are going to make a big comeback. Banks, iron ore producers, and many, many others. Another super cycle, of course, is the commodity cycle. It was predicted, as you can see here, that at some point prices would pick up and form a new cycle. I think everyone investing in resources stocks needs to take a very, very good look at what happened in the share market over the past years, the polarization. And I think after the initial enthusiasm about having a new cycle in commodities, what we will see is increasingly a polarization amongst commodities. Like long term, whether you like it or not, but coal is not gonna benefit as much as copper, for example, and it's only waiting until the tide will turn for crude oil. And it would appear, for example, that nickel has already fallen off the bandwagon. Copper and some of the other commodities are most likely looking towards a very bright future. It's also because we are decarbonizing economies and we are developing new types of batteries and electric vehicles. And that will be the driver behind the cycle that we're experiencing, and not every commodity is linked to that cycle. When we go to the future in the background, we will still have central bankers intervening in markets and very much trying to control the markets. That's a lot easier when you depress bond yields and you inject a lot of liquidity in the markets. Just as a side remark, the Bank of Japan is now the single largest owner of equities on the Japanese stock exchange. Think about that for 5 seconds. And it's increasingly going to be difficult to unwind everything they have put in place, in particular because financial markets, they can become unruly, in particular because they're not 100% controlled. So volatility for the next few years, and at times some kind of dilemmas for central bankers, how they can ultimately wean themselves off these interventions will become increasingly a problem. We are living through a time of high valuations. Get used to it, I would say. Although the market will get uncomfortable if we do get a period of higher bond yields, because they will depress valuations. Probably the most important thing to make here is that as long as we have low bond yields and low inflation, we will have higher valuations, all else being equal, if we keep on growing. What makes people uncomfortable, including myself at times, is that we are in a bull market, and at the moment it is leading to ever more risk-taking, even by professional investors. This is a survey taken by Bank of America Merrill Lynch in January, and you can see that internationally fund managers were increasingly taking on board more and more risk, typical what happens in bull markets. The problem with that, of course, is that at some point higher valuations based on higher risk-taking, on higher forecasts, also increase the risk that something might go wrong at some point. My favorites to look at in terms of what could possibly go wrong is probably economic forecasts that might disappoint, or profit growth, and of course the bond market. The bond market is, I think, the number one factor that might distort the party this year. And that is because if you wonder why the best way to see the bond market is like the oil market. When oil goes up in price, everyone thinks that's a good thing, and we buy the likes of Woodside and Santos, because behind the rise in oil is usually a better environment for those companies and a better growth economically. But there comes a point, like for example we saw in the first half of 2008, when oil just goes way too high, way too quickly, and what then follows is economic recession, which is bad for everyone. And that's the same with bond yields. I mean, if it goes up too high too quickly, then we will get tightening, we will get less economic growth, and we might even get a recession. And that is the reason why ultimately the share market will sell off if bond yields go too high. My private indicator to how market sentiment is positioned in the market is I compare bank share prices with targets set by stockbrokers. This is ANZ Bank. You can see on this gray zone in the back that the share price last week moved well beyond targets. It has been pulling back since. Most banks are around that level. I'm not so sure whether we will see a lot of increase in those targets, but it signifies here that valuations are high, risk-taking is high, optimism is very high in these markets. Always very difficult to pick how exactly that's going to work out. This week in particular, I wrote a story about how some of the indicators from which are much more sophisticated and which are used by the likes of Citi and elsewhere on Wall Street, they are indicating something similar, that markets might be heading too high in the short term. We'll have to see how this points out. In very polarized markets that are dominated by bond market shenanigans, it's not always easy to pinpoint. But and by the way, I mean people have been talking about a pause in the bull market since last year, and it hasn't happened so far. But I do observe that most equity markets this year are sort of moving within a price range, and it's basically going sideways. Now, with those observations, I would like to go to Q&A now, with two exceptions. If anyone's interested, I do my research specifically concentrates around what I call the all-weather performance in the market. I do run a portfolio on that basis, and if you like my type of research and you would like to read more and to expand your horizon a little bit, I regularly put together a secret report, which you can find if you put /secret after the URL of the FNArena.com website. That report is for free. You can download it. It gives you half a dozen of stories I've written in the past, but that hopefully give you a different perspective on investing and in the share market.